Hello, and welcome back to another episode of the Investor Financing Podcast. And I'm your host, Beau. And on today's show, we're going to discuss for small multifamily properties, an acquisition and refinance strategy, aka the Beau method. Some tips and tricks that might help you along your real estate investing journey as far as the financing side. Let's say you're looking at a building that's 5-10 units and multifamily property, and it has some sort of value add component. Maybe the occupancy is low, maybe 50 or 60% is occupied, or maybe the property needs a substantial renovation, and then you can bump rents. And so, once you implement your plan and execute your plan, the property will be worth a lot more money. And at that time, you want to refinance.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, this is Beau, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again. So on a 1 to 4 unit, we can get up to 100% financing on bridge financing. We can do 1 to 4, we could do 100% financing potentially. But on the 5 to 10 unit properties, let's say, what we're going to be looking at is usually about 85% of total project costs you're able to finance. You might be able to finance 80% of the purchase price, 100% of the CapEx or the rehab budget with one of these fix and flip type of loans, right? So you get in there, have your construction budget ready. You're ready now to implement your plan. Once you close escrow, you remodel the property, you raise rents, you fill vacancies, and now you stabilize the property. And at this time, depending on how long it took you to do this, you're going to look to refinance the property with a DSCR loan. So instead of going to a bank or a credit union where they're going to potentially ask for tax returns and so forth, you might want to look at a DSCR loan because the rates are historically pretty darn good. And also, there's less paperwork. That's another plus. And a lot of banks and credit unions, their amortization is only usually 20 or 25 years. Many of them don't do 30. However, some do 30-year AMs, but not all. The majority do 20 to 25-year amortization. So if you look at the DSCR loans, those are amortized over 30 years and the rates are comparative. So in my mind, it's an easier route to go for financing and rates are comparable in today's market. So what we would do is we'd go in there with high leverage bridge financing. We'd fix the property up. We'd do the value add component, whether that's just vacancy, lease up, or a heavy rehab, stabilize the property, occupy it up, and then we refinance with a DSCR loan. So anyways, if you have any questions on this strategy, please book a call below. And as always, I appreciate you watching the Investor Financing Podcast. And I'm your host, Beau. Please like, subscribe, and I'll see you on the next episode.